Hello and welcome to Financial Technology Frontiers Live. We are in for a very insightful conversation in the area of transition to transformation. And in this series, we are now talking to a very insightful and very in depth conversation with FIS, which is a leader in the area of payments, one of the largest companies in the banking technology space. FIS has solutions in almost all the aspects of banking and financial services. And today we are talking to Mr. Vikram Aligh, who is heading the commercial business for North America for FIS. Vikram, welcome to Financial Technology Frontiers Live. You have been working with a lot of banks in this part of the world. When you see the technology and business transformations that are currently underway in this sector, especially in the banks, what kind of transformations are you seeing in corporate banking, cash management, or trade finance and payments, etc.?
There are a number of threads to transformation of this kind. It's either being driven through regulation, so we're seeing a lot of regulatory pressure that's forcing banks to look at doing things differently, whether it's a better lens towards fraud and sanction screening, whether it is compliance with changing norms in the industry. So we're seeing, as an example, the industry in payments move to adopt ISO 20022 as the standard for a lot of payment processing for instant payments or even RTGS payments in various parts of the world, including in North America. And that's causing banks to have to comply and go through a transformation on their side in alignment with such regulatory or market demands. The other is being driven by customers. So in the consumer space, as an example, customers have gotten used to technology helping their day-to-day lives. We've seen this with the proliferation of personal finance apps, payments being made using QR codes all over the world, not just in the US. On the corporate banking side, that change has been slow to come by, so it hasn't been as transformational. But the same consumers that are now playing roles in corporates are demanding a level of capability of their banks. So banks having to go through a transformation associated with better client servicing, better interfacing with the customers that's more seamless, so they take the friction out of the process, and are able to create not only a better experience for the client working with the bank on a day-to-day basis, but also get a bigger share of the client's business. In the corporate banking space, one of the metrics that banks will use quite often is what percentage of their corporate customers are using the bank as a transaction bank versus as a concentration bank or a principal bank. And a lot of banks are looking to increase that percentage because that means those corporates are parking their surplus funds with the bank at the end of the day, which just helps the bank get a bigger share of wallet from their clients. So they're trying to create product capability that takes into account the broader spectrum of what they want to work with the bank, with the corporate on, and then aligning how they price their products at a holistic level, better account analysis that offsets fees for things like transactions against benefit of leaving surplus balances with the account or with the bank. So we're seeing a lot of focus on optimizing fee and revenue income in the corporate banking space.
Interesting. So, a lot happening in this area, and one of the important thing is the ISO standards transformation that is also very rampant amongst the banks these days. When these banks are getting into this level of transformation, what are the kind of challenges you see, especially when you work with these banks in fast tracking their transformation, and how do these banks handle them?
Most banks have been running legacy platforms that don't speak ISO, in a manner of speaking. So they've built systems, processes, reporting capabilities, analytical capabilities around an older data standard that is limiting when you start looking at how to move the entire ecosystem over to take benefits from what ISO 20022 will bring. Most banks that have done it well have looked at this not only from the perspective of checking a box to say, I'm going to transform what I send to the world and get from the world into ISO, but yet within the walls of the bank will continue to operate using limited data that I've always been using. That checks the box from a messaging perspective, but it doesn't really check the box in terms of enhanced due diligence or better reporting capability, value-added services a bank can offer its customers, which ISO 20022 as a data format does support. So we're seeing banks that do this well are taking a broader approach across our ecosystem and transforming not just one of their systems, but how they store data, how they use data, how they make that available to their customers for things like straight-through reconciliation on receivables, as an example. That.
So, do you see a challenge when they have to modernize that legacy into the new age data? Is there any difficulty, or does it take time, or what kind of challenge comes in between?
As they say in the industry, your mileage may vary, right? Every bank has its own way of working with initiatives of the sort. The challenges we usually find are legacy systems that are very expensive and time consuming to transform to be able to support, just sticking with ISO as an example, ISO 20022 and the associated data set. There are also challenges with training both customers and staff to be able to change, modify, improve the way they've been working to take advantage of what this additional data set offers. Traditionally, if you just look at the receivables world in the transaction banking space, a corporate would get an incoming payment against an open invoice in their books separately from advice that could come in as an email or a fax or sometimes even a phone call that tells them what that payment was for. And then they'd have to work to reconcile that and eventually apply that payment to an open invoice on their ERP systems. That can go away if we're able to use the remittance information that's contained within ISO 20022 as a message format, especially with some of the rails in the industry today that offer things like request for payment. So if the biller in question or the supplier in the B2B space can initiate a request for payment and then get paid as a response to that request for payment, now that payment can be applied in a completely reconciled manner to the ERP without any manual intervention in the process. So there are significant opportunities for improvement, but it takes training. It takes training on the corporate side that can send information appropriately. It takes training on the bank's operations side. And then obviously it takes training from a systems perspective as well to be able to take advantage of that data set.
Perfect. So, coming to the experience perspective, so when organizations are deploying resources, now from the experience perspective of the resources, how can that be made better in terms of the transition of to these new technologies on one side? On the other side is the customer's experience. How are organizations working around both this, and how are vendors like you working on it?
Yeah, some of the banks have chosen to bring in external help when looking at taking stock of what the current ecosystem looks like. So some banks have relied on consulting partners to come and talk to them about should they transition to the future way of working, whether it's around compliance with ISO and taking advantage of all the benefits that ISO 20022 brings to the table, or modifying the way they've set up their systems so that they can open up all of that capability to their customers through a set of APIs versus the traditional way of connecting into the bank services. They've often brought in consulting partners to help them identify where there might be gaps in the broader capabilities of the bank, and then how they need to address those gaps. And it could be a combination of systems, processes, and/or training. So they've gone about that initiative by looking at external help where needed. From a systems perspective, um, most banks will look at what existing systems that they've been operating on can be extended to support the new way of working. So if it's possible to extend it, through either technology addition or customization or putting a wrapper on things that operate and operate well. That might be one approach towards preparing for where the bank wants to go.
Mm-hmm.
The second category of initiatives might be having to replace things that just cannot be extended effectively. And then a third one which we're seeing, especially as take the example of North America, as there are new payment rails in the industry. RTP was launched a little over 5 years ago by the clearinghouse. The Fed has just launched the Fed Now Instant Payment Network. Because banks have not been offering that capability, that would mean adding net new functionality through either new systems or new partners so that the banks can check that box and start offering capability that they've not offered in the past.
Mm-hmm.
Both changes in the market and new technology innovations are allowing banks to offer net new capability to that regard. So we're seeing additions of capability, technology or otherwise, quite consistently in various banks that we speak with in North America.
And how are banks actually trying to better the experiences in real-time payments now, especially since they are not used to, the customers are not used to real-time payments? What new experiences are coming in?
Certain segments of customers have gotten used to a degree of real-time payment capability. They've been using wallets provided by a number of firms in the industry, whom I will not name, but there's a lot of wallet providers, right?
Absolutely.
So to the end consumer, whether it's through the use of a wallet or whether it is to the use of a credit card at the point of sale, or it is through use of something called, right, Zelle's been around for a while. For the end consumer, that money movement is still relatively real time, right? They don't care whether or not the settlement's happening in real time or not.
Correct.
As banks start to offer true real time capability through instant payment rails like RTP or Fed Now, and therefore real time settlement of those payments as well, banks are working both directly to enhance their client facing channels to allow for true real time payment origination for use cases that were just not possible before these rails came into existence. Others are working with partners that can create, I'll call them overlays on top of these rails that enable the users, the customers of the banks, whether these are consumers which already have some degree of real-time money movement capability through Zelle and other such providers, but also small businesses and large corporates, the ability to take advantage of these. So they're enhancing their portal or channel solutions, but also working with, say, ERP providers that can improve the real-time nature of the ERP systems that corporates have been using, as well as the ability to handle what we talked about earlier, which is the ISO 222 days set.
Interesting. And when you come to pricing of these products and services, what are the key trends? Okay, how are banks looking at customizing the pricings of these products and services and making it more lucrative for the customers?
Banks have had a long-standing monetization model in place for services they offer customers, whether it is on loans and other lines of credit they might open up to customers, or it's transaction-based revenue, right? So P times V, the ability to price a product, multiply that by the volume that they process, that becomes what they charge the customer for. I think increasingly banks are taking a more holistic view of how they charge their customers, so not looking at individual transactions alone or individual credit payments alone, but what is the total value of the customer's relationship with the bank, and find a pricing model that reflects that broader relationship to the bank, or value of that relationship to the bank. Figure out what that means in terms of monetary terms, and therefore use that to inform how they price specific products. So in the commercial space, it's not uncommon to look at account analysis and using what average surplus balances a corporate is left with the bank to try and compute what can be offset in terms of their transaction-based fees for the month. This is just coming into more and more focus because the banks are also trying to fight against being disintermediated from the process by fintechs that have continued to chip away at what capabilities that banks are able to provide small business, mid-market, and in some cases large corporates as well. Um,
Interesting.
so to be able to keep that relationship and the broader share of wallet, banks are certainly looking at how to optimize individual transaction-based pricing, but also broader relationship-based pricing
And
for
do you have any solutions in this area directly to the customer, or you have third party or partner solutions there?
we offer solutions to the financial institutions that allow them to implement a revenue strategy very similar to what I've just outlined, which is to look at product pricing and bundling, relationship-based pricing, account analysis, and associated billing holistically for the client's relationships. It's an area that we've had a long-standing footprint in, but we're only continuing to expand that with better functional capability and technology advances that FIS is continuing to invest in.
Wonderful. So you are already working in that area. When it comes to these kind of engagements, especially in transformation of payments, do you see a major role for technology side or the business side?
It's certainly both. You can't have one be successful without the
But
other.
which one prioritizes?
I don't know if I could pick one between the two, only because for a successful initiative, you need to have a business case, and then obviously the business side is going to go make the business case for investment into technology or operations that help them get there. And then you need technology and operations to be able to do the how against the business's what. Um, Unless they're working hand in glove, chances are the initiative is going to fail because either there's not enough well thought through business drivers behind the initiative, or it's poor execution of the vision, and therefore you can't really deliver on the promise of what the business case
So it's a
was.
combination factor.
It almost has to be a combination. Any
But
successful
what first? No idea.
the business case has to come first, because if you don't have a business case, how do you justify investing in newer technology or even expanding existing technology? If you do a project for technology's sake alone, chances are you're not going to have the right drivers.
Business buy-in.
You might not have the buy-in, even if the technology, the arm of the financial institution is able to fund the initiative. What value does it eventually deliver to the financial institution? Unless it's cost reduction, right? So if the business case is around cost associated with tech and ops, you could have a tech-led initiative to reduce or optimize costs.
Wonderful. And the last question is, what is the role of the consultants there? And generally, how long is the transition process for most of these trade finance or cash management things?
I think consultants help bring an outside-in perspective, especially with financial institutions that have been so inwardly focused for the longest time. They have either not had a finger on the pulse of where the industry is going in terms of innovations that can help them improve how they've been operating, what products they offer, what untapped potential there might be in the market out there. So consultants definitely bring that outside-in perspective to inform the banks in terms of where the industry is and what might be opportunities for the financial institutions to tap into. The other area where consultants sometimes have added really good value, in our view, is a roadmap to execute on critical initiatives in terms of how to approach a transformation initiative. It's not just implement something and all the other parts will fall into place. There's a significant amount of change management, process re-engineering, training of people, both internally and externally, and just taking a holistic view on these things helps, and that's what consultants have added.
So you generally work with top consultants in this area mostly, or you work directly with the banks?
We, as an organization, we've worked in all those models where we've either worked directly with the financial institutions who either have expertise in-house or partner with consultants to provide them expertise of the kind that we just talked about. In some cases, we have partnered with SI partners or consulting organizations to take a more holistic value proposition to the financial institutions that may be going through a transformation journey of this kind. So
depends upon the organization to organization.
On a case-by-case basis, right? We're not biased towards one model or the other, but we want to make sure that for the client in question, the financial institution, for the case in point, we're able to provide them the options that will best help them succeed at whatever initiatives they're taking on.
Perfect.